Hello, everyone. I'm Cassandra Forche. I am joined today with our principal broker, Vince Scarselli. Thank you so much for joining us, Vince, today.
Thanks, Cass. Hi, everyone.
So last meeting that we had, or last YouTube video, I should say, that Vince and I recorded, we got into a little bit about reverse mortgages. So I asked Vince to sit down with me to discuss what a reverse mortgage is and to demystify some of the facts out there, or I should say misfacts out there about reverse mortgages.
Right.
We got a lot of interaction from our database when we sent out our last video. Some great questions were asked, so I actually jotted some down. And we're just going to hear it from him live. I haven't prepped him yet, so these are real, true answers directly from the source. And always feel free to send in questions if there's anything that we didn't touch on today that you want to know more about. So let's get started with the first question.
Okay.
What is a reverse mortgage?
I would say what I tell people generally to ensure they have proper understanding of the product is that it's actually just a mortgage. It's a mortgage like any other mortgage. The main difference is going to be in the payment. So typically a mortgage would have an amortization, which then has a monthly or regular systematic payment that comes out of your bank account. Mm-hmm. The difference between a regular mortgage and a reverse mortgage is that that payment no longer exists. So you still have a mortgage that's registered on the property, let's say for $200,000, and rather than the payment of principal and interest coming out of your bank account on a monthly basis, that no longer occurs, and there's a payment that's going to be, that payment of interest would then be added onto the mortgage. So rather than your mortgage declining down every month, the actual mortgage climbs by the amount of interest that's being charged. So that's pretty much the main difference between the two.
So that sounds really good. I would love to not have a mortgage payment. Obviously, I don't think I qualify for this. So maybe you can identify who is this product right for?
Yeah, so there are some definite limitations on this product. It's not for everyone. There's actually an age minimum on this product. It's typically 55 years of age. Mm-hmm. And the reason for that, Cass, is because the longer you're in this product, the more interest is accrued over time, because remember, you're not making a payment on the principal.
Right.
So if you're starting at 55 years of age, generally speaking, even your mortgage balance, or the amount that you would actually qualify for, would be significantly lower than someone who started off at the age of 75.
Right.
Right? Because they have longer to live at the age of 55 than they do 75 based on the statistics, right? So that's the main reason. So 55 years of age, that's how it works. You wanted to know what else? How people qualify for it? Is that essentially?
Yeah, how people qualify for it. And I do have a follow-up question after that. So why don't you dive into that?
Yeah, so qualification is pretty straightforward. For us, it's more about suitability. We really need to make sure it's suitable for the client, it's the right decision. And so there are various things that we go through and calculations we go through with the client to make sure that they're comfortable and understand the product fully. But how we qualify the product is simply because you no longer have a mortgage payment. We still have to make sure that the income you receive, typically pension income in retirement, is enough to cover things like property taxes and other bills that you have, like heat, cable, phone, like all these other things, right? That's where it's really, really important to make sure. That's how we qualify that product.
Okay, that's great. So my follow-up question would be, with a reverse mortgage, obviously I'm getting some money from the mortgage company, maybe to pay off a previous mortgage, but what other ways can I use the funds from my reverse mortgage?
I mean, really, the sky's the limit. So there's many ways. Now, this product has evolved with various lenders over time, which means that you can get a lump sum, pay off an existing mortgage. Let's say if your mortgage is up for maturity, or you have an existing secured line of credit, that mortgage is issued. It replaces that secured line of credit or the existing mortgage that no longer exists. There's only that one mortgage on it, right? You're no longer making a payment. And if there's a surplus of funds, then you're able to, some people buy a car with it. Some people do renovations on their home. Some people gift to their kids or their grandkids for down payment or other purposes. There's also an ability to get an approval for a higher amount, but not actually use the full amount, and have a just in case sort of fund if you needed it. So you would take $200,000 now. Let's say you're approved for $400,000. That client can then call us later on. It could be 5 years down the road and say, "Hey, Cass, I actually need another $50,000. Can I get that?" and we don't no longer have to go through the approval process.
Right, and they've not been paying interest on that portion just sitting in their bank account
Absolutely.
this whole time doing nothing.
Yeah.
So they can take it out in a lump sum. I also know some clients take advantage of monthly draws, so automatic cash injections into their bank account to help supplement the cost of living. You know, CPP and OAS will only cover so much. So some people will choose to supplement their lifestyle, helps them do things like go on vacation, join recreational activities, dine out, just really enjoy retirement. And another great point you made about down payment for children. It's a nice way to gift that inheritance in advance and watch your children use it for one of their goals. And it also kind of helps on the other end too. When a parent does unfortunately pass, that estate planning has already been taken care of, and that child has already gotten that cash injection from their parents instead of waiting until the estate has cleared, which can sometimes take upwards of a year.
I think a big feature for this in terms of suitability is it allows people to stay in their home longer.
That's true.
That's a big kick. Like when we're sitting down with clients and you sit down with them and you go through this planning, a lot of them worry as a couple if one would pass on, what would happen with the other person, because now that other person, their spouse, is now maybe going to receive half the income or somewhat less income than they were receiving earlier. So there's less disposable income in the house. That's not going to be impacted by the mortgage. So it allows them either together or later on in years, if they were to be separate, that basically they could stay in their home and decide when they want to sell the house.
You'll remember that when I first started with you, one of the first questions I asked you was, hey, have you ever done a reverse mortgage? And that's because I worked in the retirement industry for so long, and it's a very expensive way to live. There is definitely a market for people to move into a retirement community, and they really enjoy that type of lifestyle. There was many that did not. They would have preferred to stay in their home, and many who cannot afford private retirement. It's very expensive, where taking a bit of a cash injection from your reverse mortgage and retrofitting the home so that you can continue to stay in your home, or maybe pay for some nursing care to come to your home, is the better option for some people. Okay, well, I think is there anything you want to add before we jump into the myths?
No, let's do it.
Okay, let's jump in.
Put me on the spot.
Okay, so the first one, we got this one like so many times. This is the biggest misconception. Somebody else will own my home. Who owns your home?
You will always own your home.
The
bank does not own your home. The bank has a registration on the title of your home, just like a regular mortgage. It's the same thing. Nothing changes. And so that's really important. We get this question a lot. So this is a very common question.
Yeah, and often the follow-up is like, well, the bank will own my home when I pass, and then the family home will not be left to my children in the event that I do pass away.
Negative. Completely negative. Yeah, that's not happening.
Your estate planning will remain the same.
Yeah, everything stays the same. Your mortgage registered on the property, and you owe what is owed in terms of interest and principal. That's it.
That's right. Okay, next one. The bank can sell or foreclose on my home. Now, this kind of piggybacks on the last question, because this would imply that the bank does have ownership on your home. But how does that work? Can the bank ever kick you out of your house?
No. So again, it's really, really important that it's made clear to everybody, even I would say children, grown children whose parents are considering a reverse mortgage, that they understand that the bank does not own their home. They're not losing out on that. Nothing is going to occur to this home, that they're in full control, basically. And we make that very, very clear. The bank is not going to kick you out. You're not missing payments because you're not making payments, right? You still are responsible for making property tax payments. You're still responsible to ensure that this home is owner occupied. Okay, so there's some. And
an important thing there, owner occupied for at least 6 months of the year. So it does cover those snowbirds that want to fly away to, say, Florida and enjoy some warm weather. So it's still a suitable option for those individuals as well who maybe have a second home.
Absolutely. And so it's just really important. That's more for insurance purposes as well. They want to make sure that that the home is occupied. So there are certain expectations that have to be met that are totally reasonable.
And the same as any other mortgage, you're responsible to maintain the home, keep it in good working order, pay your property taxes. just in this case, they don't have the added ability to foreclose if you didn't miss a payment, because you're going to miss years of payments.
Yeah, because you're not making them. Exactly, because you're not making them.
Great. So another misconception is how expensive obtaining a reverse mortgage can be.
You know what? I would say that probably is rooted from, history.
Right.
Reverse mortgages have been around for quite some time, and so they've become far more efficient because there's competition. We love competition. That's the basis of why we have access to so many lenders, is because we can provide competition and the benefit of competition to our clients. And so I would say, no, it's much cheaper now than it ever was.
Right.
A setup fee could be as little as $9.95.
Yeah.
And you have to go to a lawyer to get due legals, just like you do for any sort of mortgage that you're setting up. Some have independent legal advice, which has to be taken through a different lawyer as well. So that could be some added legal fees, but totally reasonable overall in terms of rate, because that's probably a question you're going to say in terms of differential compared to a current bank rate versus a bank doing a reverse mortgage. You're talking, a difference of maybe 1% or so,
which is reasonable. I mean, the bank is not making any money up front other than a very small setup fee. To your point, it's less than $1,000 in most cases. For them to just hold on to wait to get their payout, I do think there is value in that extra 1 or 1.5% to have this type of mortgage versus having a principal and interest payment. It makes sense why they would have to charge a small premium.
Yeah, and it's certainly not a gouge. At the end of the day, I've made this comparison for clients. If you have a secured line of credit that's at prime plus a half or prime plus 1, you're certainly going to have the opportunity of actually saving on interest and not having a payment by going through the reverse mortgage process. So a lot of our clients have seen that rates have come up substantially in the last year. Their payments have gone up substantially on a line of credit, secured line of credit, because that's interest only. So literally they feel it every time. And therefore, now they're saying, what? This is just adding onto my bills every month, and it's stressing me out.
Right.
So we've converted a lot of those people in a suitable product, such as a reverse mortgage, which essentially pays off the line, and they no longer have that payment. They were paying that interest anyways, at least that, if not more. So it becomes a serious conversation, something to consider.
It is also easier to really dip into a line of credit and maybe overspend in some cases.
Totally.
Okay, so this is a good one. A lot of people think that this is like a shared equity program, and that the bank, in the end, once both parties have passed away, that when that mortgage is paid out and say that home is sold, that the bank is going to have some rights to that appreciation value on the home.
Also very false.
Yeah.
So again, this performs as a regular mortgage. You have $200,000, and over a period of 15 years, you've accrued a certain amount of interest, and the value has gone up substantially more, and the equity has grown. The bank has no right to that equity. The way I like to use it, and in fact, a lot of our simulations that we actually put together for clients that are visuals will assume, for example, a 3% increase in value annually on a property, which is very nominal. Okay, so and then would assume a certain rate of interest on the balance that you're borrowing on. And so if you were to really think of it, that 3% on a value of, let's say, 700,000 or 800,000 is a lot more than the interest cost you're going to pay on a mortgage of a few $100,000. So it ends up being, you're always going to be growing your equity. You're just not going to be growing it at a pace that you'd be growing if you were making payments every month. So there's a trade-off, right?
And that's why all the reverse mortgage lenders have a low cap on the loan to value that you are able to access.
Absolutely.
So it does allow a big buffer space for the equity to continue to build and the mortgage not surpass what the value of that home is. Now, this wasn't one of the questions that we got, but I have heard it before, so it kind of ties into this. A couple people have mentioned negative equity. So because of the last year and a half where values have gone down, in some cases quite substantially, what happens if at the period in which the home is sold and that mortgage is paid out, that the value of the home has now dropped and they now owe more than the value of the home?
Right. I would preface this by saying that the probability of this happening is very, very low.
Again, because of the amount of equity they build in from the start.
Yeah, they're not allowed they won't lend close to the value of your property, nowhere near to even close. However, if that were to occur, all of these mortgages are built to not allow the client to be responsible for that negative equity.
Yeah, so that would,
be a wash.
It would be a wash.
It'd be a wash. But again, just to say, it's the probability of that happening is extremely low, next to none.
The other misconception, the last one that I've got here, is a lot of people think that there's no option to make prepayments to control that interest cost, because a lot of people are worried about the amount of inheritance that they're going to leave over for their family. So they want to, from the forefront, say, hey, could I make payments to reduce that interest cost to leave a little bit more equity? And there's a misconception that once you are in a reverse mortgage, that you cannot get out, or that the penalty to break that mortgage outside of the regular parameters, which would be usually when they pass and then you sell the home. If you decided this isn't the right product for me, I want to sell and I want to get out of this mortgage, it's very expensive to do so.
Again, I feel like the more we talk about it, the more we realize how much it parallels a regular mortgage.
Oh, absolutely.
So if you think of let's take the latter question first. You're in control of the house. So you can decide to sell the house.
Yep.
You can decide to refinance and pay it off into a different mortgage if you want. If you no longer thought your situation
or
changed.
If you came into inheritance yourself and decided to pay it off and just have a free and clear home, it is an option.
Or if one of your children, we're seeing where generations are fusing into a household. So if all of a sudden your children are moving into their family into the house, and now all of a sudden they're selling the property, you can go ahead and pay it off or refinance.
So what would that penalty look like?
It's very nominal. So in general, you're probably looking anywhere between 3 months interest penalty, which is what we see, to a maximum of about 5 months of interest penalty. So we're nothing is earth shattering. It's not crazy. Again, the amounts are small, and the penalties are very reasonable.
And after, I think it's the 11th year, or in the 11th year, it's no penalty. And of course, if somebody passes, and that's why it's being paid off, there's no penalty.
Right, and you also have the ability to prepay. So that was the first question you had. Again, it operates just like a regular mortgage. In fact, although you don't have to ever pay it down, right, until you move or you pass on. The mortgage itself has a term associated to it. You have to, just like a regular mortgage, you have to choose a 3-year term or 4-year term or 5-year term. And that's in reference to the contract rate that you're going to pay on the amount you're borrowing. So if rates are higher today, you might choose a shorter term. Rates go down lower, you might choose a longer term. You could do fixed or variable on all these. And within those, there's an allowance for prepayment. So if you do come into some money, then you are able to prepay that mortgage. It goes directly against the principal and reduces that calculation of interest and the accrued interest that is paid over time. Right.
So that concludes all of the misconceptions that I had. What else do you want people to know about a reverse mortgage?
I think what's important is to make it a family discussion. I really believe it's important. I've seen or heard, really, we haven't had any clients of ours, but I've heard of clients doing this and not having a discussion with their children, and then there could be some arguments because the children don't understand the product. So I like to tell clients to bring those that they think are should be coming to the table together, so we can answer all the questions, make sure everyone's on the same page, make sure there's transparency, make sure that everyone who should be involved is involved, so that we can have an open conversation. I think that's really, really important.
Okay, great. Well, thank you so much for your time, Vince. I think that answers all of our questions. But of course, if anyone does have any questions or would like to book a call with us to discuss if you think this product might be right for you, of course, reach out. We're always happy to chat. Thank you.